Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Indian equity markets are inching towards life highs, and recent data from rate hike pause from the RBI and the US Fed to SIPs hitting all-time highs. Market seems poised for an extended bull run. So, in the current market scenario, how should retail investors plan their investments? What are the strategies that can help them get the most of their investments? Let's answer all of these questions. I have Shweta Rajani, Head Mutual Fund, Anand Rathi Limited, Ashish Kapur, CEO, Invest Shoppe India. Ashish, Shweta, good evening and welcome to the show. So Ashish, coming to you first, how do you read these all data coming from international data and Indian data, and even this particular week, that's very crucial. How do you read this data, and how would you like to decode this for an investor who has lined up their goals depending on the kind of market trajectory that we are seeing right now? If the goals are lined up properly, do they need to change their portfolio?
Yeah, hi. Thank you so much for having me over. Well, I think, frankly speaking, most of this, data which we are seeing or which we will see are, kind of, I would put it like that, put it a little bluntly, but I would say they are kind of noises which actually should not affect the investors. They are more for traders. So firstly, we need to define, are we investors or are we traders? I mean, of course, if we are traders, then we have to look at all these noises and react on them. If we are investor, then I believe you have some kind of, asset allocation in place and you have to follow that. And within the asset allocation, whatever you have put in equities is either managed through a PMS or a mutual fund, or if it's being done directly, then the stocks are the ones in which you have done your research or you have used somebody's help to do research. These things will not move by the market being near all-time high, or the fact that there is a lot of data which is going to come from global markets. These data points keep happening. Markets keep going up and down. You really have to go on your journey and see that you are, going as per your needs, your profile, and the shares or any other investment which you are choosing is well researched and matches with your goal and your profile. So as long as you've done that, I think this should not matter at all. In fact, this is part of the course. I think markets will go high. If you ask me, yes, time to certainly look at your portfolio, equity portfolio, and see if you can balance it a bit. If there is some things which have gone to your target, some stocks have hit your target, certainly book profits and move out. But don't base your decisions just on the fact that the market is near all-time high. Markets can go much higher. Markets do not follow any kind of rule like that. And near all-time high means it's an expensive market. So if there are some stocks which have reached your target, certainly book. Have a relook like you always do at the portfolio. Look at new ideas. If there's something which in your portfolio which is not giving you that kind of confidence, certainly book that and move into something which is looking better. All that relook and rewire and study of your portfolio.
So that is a very important point. Exactly, that's a very important.
Nothing much in particular.
Yeah, that's a very important point that you're stressing on, and I think Shweta might want to elaborate, is maybe rebalancing and reallocation in your portfolio. Because if you are an investor who's following a diversified strategy across asset classes, this is a time where you might want to just adjust your portfolio. Doesn't matter if you have any goals aligned with it. I mean, that's obviously should be the prime reason why you have a diversified portfolio. But then if you are seeing profit in equity, time to just divert it somewhere. Shweta?
Yeah, so you're absolutely right that it all starts from you setting your goal, and to get to that return goal as well as the risk goal. Yeah. So when you talk about goal, it's not just your return. You may be wanting to target a 12, 13, 14% return, but at what risk level? That will help you take the next critical step, which is getting the right asset mix. So you may so choose to have a 70% equity and a 30% debt in your portfolio, irrespective of where the market level is. If you are at that 70% equity today, then continue with that allocation. You need not reduce it just because market is showing that it's nearing its all-time high level. No, that should not be the case. However, let's say you're 70% equity, you can have a plus minus 5% range. But if that 70 has gone to an 80% equity, then that's time for you to rebalance your portfolio and get it back to 70. But if you're still at 60% or 65% of equity on your portfolio today, then don't be worried about where the market level is. In fact, this is a level where you need to build in and get to your desired 70% allocation. So build in that. I'll just say one thing, that looking at the way the market is going today, you can have some shift within your portfolio, or some corrective measures that you may need to do so that you're aligning it to the changing market dynamics. For example, your large cap and your mid caps are trading at fair value. It's not expensive. I'll say it's not cheap. It's trading at a fair value. But your small caps, on the other hand, are trading at a discount to your fair value. So, within your allocation that you have, the 70% equity portion of the portfolio that you're maintaining, you may probably want to shift a little more towards small cap. So what we've been suggesting is have a 50% large, 20% mid, and a 30% small in your portfolio, because market is throwing up where there's a slight more attractiveness, whether it's your current valuations, whether it is what you're expecting in terms of earnings for the next 1 year, or a mean reversion to play out in small caps. So look at those indications that are coming in from the market and see how you want to realign your portfolio and rebalance it only if you're above a certain range on your desired asset mix.
Interesting. Ashish, I also want to understand, so obviously now on radar, we'll be having the New Year's first quarter results, okay, those earning numbers. These are all near-term and short-term triggers that I'm talking about and discussing about. We'll further go into a long-term strategy or maybe a goal-aligned strategy with Shweta. But the kind of sense that you are getting right now for the first quarter earning results, which will actually decide the trajectory of the markets for next few months or maybe this calendar year end. How do you see it rolling out, and how high? Because you just mentioned in your earlier answer, market can go higher than this as well. So how high do you think the market is going to fly now?
See, the best answer to that is again that, markets can surprise us. If you're asking me for my guess of what is going to happen in the first quarter results, I think all the indications are pointing out that we are going to have a very good earnings season, because the economy seems to be really coming back in a very strong way. You can notice that with the automobile sales, which are going up and hitting record highs. You can see that by the way a lot of consumer companies are gearing up for the festive season. So certainly the economy is doing well. There can be some concerns regarding the monsoon, but too early to say anything definite on that. And I think even if that happens, there is some delay of monsoon or less monsoon this year, then mostly it will be rural sector which might get affected. But I think the urban sector is doing pretty well. These are all guesstimates. Now, what really happens in the broader picture, which is again what I'm pointing out, that if you're an investor, you're looking at obviously a longer horizon than maybe a couple of months. And the longer picture is still very, very positive for India, because I think there is no other place no other country which is so large and growing at such a good, steady rate. And with so many other positives kicking in the very high young population, growing awareness, growing aspiration levels, increasing infrastructure. Infrastructure is really improving. The road quality, the ports, airports are really improving here. So I think the longer term trajectory is certainly going to go up. So if an investor, all you need to do is stay invested in the right kind of stocks or the right kind of PMS, mutual fund, whatever way you choose. There is no looking back. I mean, the couple of months here and there can go either way and should not deter you or change your course of action. I think whatever money you can spare or you have decided to keep it for equity should stay that way and should not move in or out just because monsoon might be a little weak. Maybe there's some valuation concerns for the very near term, or for whatever other international data point might scare you, or whatever be the other reason. I think broadly the markets are longer term trajectory is certainly up, I can tell you. It's very short term, almost everybody can go wrong. Like I told you, my guess is everything is looking very hunky dory. but it could go wrong and can have some jerks, some volatility going forward, but that should not make investors change their course or make decisions in a haste or just or based on some short-term data or some concern over something which is short-term in nature.
So Ashish, time to go heavy on mid cap, small cap. Would you recommend that?
I think again, depending on your overall allocation, I would think that yes, if you are comfortable with the risk associated with the mid and small caps, it would be a time to go a little heavier on those stock specific ideas, which can be more mid cap, more small cap, or I would say more of the new technology, more on new ideas. You can take a bit of risk, but only if you are comfortable with that kind of risk taking. Large caps are more comfortable, more easy to track, and are less volatile, and are also less risky because chance of anything going majorly wrong in a large company is less. So only if you're an investor comfortable with tracking mid cap and small cap ideas and are used to or are aware of the risk associated with them, should you go for that. But if you are that kind of investor, then yes, this is a time to maybe increase your allocation to the smaller companies, to the companies which are perhaps a bit riskier but have more long-term upside potential. Yes, you can do that. There's certainly a good time for doing that, because when the first phase of this market, what we have seen is broadly the movement coming in the larger stocks. So some of the mid and small cap ideas are still looking very attractive and haven't moved much. So that is where you can focus if you have the temperament and the research capability.
Shweta, so what kind of funds do you think one should be diversifying into? What kind of categories do you think one can actually bank on or maybe add on in their portfolio if it's missing?
Sure. You have today 10 categories which are defined by SEBI. But if I further break it up, then some of these categories, if you see their 5-year trend, the potential for alpha generation or return generation seems to be lower than others. So one category I would say that you can avoid in your portfolio or have a very low allocation is the large cap fund category itself. Have a 50% large cap exposure to your portfolio, but build that through categories like large and mid, flexi, focus. Those are certain categories that you should have in your portfolio. Definitely have a multi and a small cap because, like I mentioned, the small cap space at this point of time is looking attractive from a valuation standpoint as well as the earnings growth expectation. So these are two categories you must have. A contra category, to have something different or unique style bringing into your portfolio, and a dividend yield. So constructed in such a fashion where you have a well balance between large, mid, small. You'll also have a blend of value and growth styles in your portfolio. So, that would be my strategy. Just repeating, have a flexi, focus, large and mid, multi, small, contra, and dividend yield as categories for your mutual fund basket.
And apart from that, if at all you want a customized portfolio, maybe you would want to send us your question on the Money Show. With that, Shweta and Ashish, thank you so much for being on the show and helping our viewers with their portfolio strategies. And we'll take a quick break, but then post that, let's get your financial portfolio checked by Hemant Stuti.